Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. I want to thank everybody for joining us. You're listening to Destination Retirement. My name is Robert Kuhn, host, president, and founder of Kuhn Capital Partners. We're independent. We are a registered investment advisory firm. And yes, we are a fiduciary. Thank you for joining us each and every weekend. I want to thank everybody for listening to the podcast as well. We see the numbers. I'm very, very pleased with how those numbers are going. I think last week we did strike a nerve when I talked a lot about annuities. So we're going to spend a little bit of time this week talking about that and kind of my thoughts on that and what is ultimately what I meant. And we'll just kind of dissect the good and the bad. But certainly with the outreach that we have had this week, I know last week it obviously a lot of people thought it was great, and a lot of people didn't like what I said about annuities. So we'll talk about that here in a minute. We are a fiduciary, like I mentioned. We do have a dinner coming up in Naperville in the beginning of June. So it is on tax reduction strategies in the energy space. If you have a net worth of over $1 million really, this qualification is just a net worth over $1 million, not including your primary residence, or make over $300,000 a year, then you meet the qualifications for this investment. It's not my qualifications, it's the SEC's qualifications. But we are going to go over how you can greatly reduce your taxable income. Last year, we were able to reduce your taxable income, active or passive, by $90,000. That is significant. $90,000 per $100,000 invested. Very, very significant. Sold a business, a building, high wage earner, embedded, concentrated stock positions, whatever it is. If you have a lot of income, you need to offset income, capital gains. Let's have a conversation. See if that dinner makes sense. Give us a call, 630-492-1912, 630-492-1912. As you know, we work with investors of all types, but for that dinner, it's $1 million net worth to qualify for the investment. So that being said, the week was great. Markets don't ever want to go down. I love it. I can't tell you how many people I know who have missed out on this rally because the markets have had to go back down. And in 25 years, I recognize that the markets don't have to do anything. What my gut feel is irrelevant. I think when you look at money management today, the days of buy and hold, asset allocated models, balanced portfolios, those are all taglines for you're working with an advisor that is not cutting edge, not proactive, and not using the latest and greatest strategies. We're in a very momentum-based market. I think if you look at what is going on with technology and you look at the speed of technology, you look at how trading is, you look at computers, you look at algorithms, you look at computer-based models. Momentum, in my opinion, is here to stay. And that is where money management is going. If you're still working with an advisor that talks about large cap growth, large cap value, large cap or international, small mid, just the total, trying to fill all style boxes, and they show you that sheet that looks like a periodic table, and it is a chart that shows no real way to guess or predict where the market is going to go. That is all very true, but you are missing out on so much. And again, we are in a momentum-based market. I don't think that is going to change. 80 to 90% of stock market volume is computer-based. All of the computer models are very similar. Everybody's got their little spin on it to make it unique in theirs, but the bottom line is this, that it is all chasing the same money. And when money flows into something, the price generally goes up. So if you are still working with an advisor that is using outdated strategies and certainly using fixed income as a means of portfolio diversifier, given and safety, given the fact that we're in the worst 4-year period in the bond market, you owe it to yourself to reach out to proactive cutting edge advisors like us that are using these strategies that take out gut feel. Because again, gut feel means nothing. Talked to the client the other day, and he said he has some money away from us, which is perfectly fine. That well, I'm going to wait for a pullback. Well, you've been saying that for the last 2,000 points, right? And you look at it, and again, if we let the computers tell us, if we let the math tell us, if we let the momentum tell us when, where, how to be invested, then you're generally going to outperform the market in potentially meaningfully. Is it perfect? Of course it's not perfect. Is it trying to time the market on a second by second tick? Of course it's not trying to do that. But there are segments of the market that are just capturing flows. Why aren't you overweighting those? So anyways, goodness, we can talk a whole lot about that, but our Growth Plus strategy is mathematical. Our Growth Plus strategy is very, very structured, algorithmic based. Again, we're not managing that. We are just giving you access to a manager that would require a significant sum of money to invest that would really just knock you out if you went direct. You probably don't have the asset base or the size to give them. We can do it for a minimum of $50,000. Again, that is for our Growth Plus strategy. So performance since 2015 in that strategy is almost 700% versus the S&P at 300%. People hear that as, oh my gosh, it's aggressive. No, it moves and it's volatile, but that's why it may only be 10 to 15 to 20% of your portfolio. So again, past performance isn't indicative of future results, but if you're looking for some money that has a proven strategy that is mathematical based, that is based upon algorithms, that is based upon data scientists, PhDs, rather than trying to outsmart the market, and find something that, you're going to go and find a stock that is just trading at a valuation that the computers can't find. Good luck with that. So if you want to learn a little bit more about that, how to complement currently what you're doing, certainly give us a call, 630-492-1912. We'd love to share that strategy with you. Again, when we look at crafting money, when we look at crafting portfolios, it's how can we make money when the markets are down? How can we outperform when the markets are up? And our philosophy is, we consider it to be very simple, but it is very complex. And if I look at other advisors that I know here in the Midwest, again, we're based in Chicago. That being said, the radio show runs in multiple markets, so we can work with you. We do have a national client base, so if you're outside of the Chicago market, we'd love to also have a conversation with you. But our job is to make sure that if the markets can go three ways, they can go up, they can go down, and they can go sideways. We want to make sure that we have protected growth, we have Growth Plus, and we have alternative/tax reduction. I can promise you, I don't know of a single advisor, certainly in Chicago, possibly in the Midwest, that is bringing you those four strategies: protected growth, a way to make money when the markets are down, and the tax strategy. Those two strategies are going to knock out 99.99% of investors or advisors as far as trying to compete with us in the offering that we bring. So 630-492-1912. If you'd like to have a conversation, let's have that conversation. Get on the calendar, and we can certainly share with you what it is that we're doing. And if we can help you, fantastic. So to annuities. People like to say that we don't like annuities. People like to say that we're haters. People like to say that, they just don't like annuities. That couldn't be further from the truth. I know if you listen to the radio show, I know if you listen to this station, that you are going to hear advisors and their shows talk about annuities all day long. That is what they're selling. That is what they're selling. I mean, some try not to say the word annuity. Some are very forthright and upfront about annuities, and that they're the answer to every single investment or every single situation. And if you listen to the show, that we do not like lifetime income annuities, and we think that you're paying for something that you're going to receive no value from. Now, that being said, if you have $100,000 of investable assets and that's it, generally we like to say under $250,000, and that's the only investable assets to your name, then you know what? A lifetime income annuity could be a very, very appropriate strategy. It could absolutely be one of the best investments. That being said, it is sold to people who don't need it, and I'm very, very concerned about why people are buying these. We're going to become very offensive about that, and we're going to be in advisors' faces about why are you selling these people annuities that have a lifetime income component when it's just not needed. So you can't say that we're against annuities, because we use a 5-year annuity, 5-year fixed income annuity. It's a growth annuity. It's very short term. It is tied simply to the S&P 500. Currently, you get what we consider to be very, very strong growth. You get the first 11.5% of the S&P. That is great. 11.5% of the S&P 500 on an annual basis. When you get that gain in the year that you invest, again, not calendar year, it's your investment year. So if you invest today, they look at it a year from now. You simply get the first 11.5% of the S&P 500. When you get that gain is locked in, never to go back down. So if the markets are down in year 2, you don't give back any of your gains. You might not make money, but you don't give back any of your gains. And then in year 3, if the market goes back up, well, you don't have to waste gains trying to recoup losses. You are able to stack those gains on top of your previous gains. And that is all that they do for 5 years. Now, you could own it forever. But the commitment is 5 years. That is an annuity. It's just a growth annuity. It is a very short-term annuity. So you can't say that we're against annuities, because we're not. That is a very core component of our protected growth strategy. There are a lot of investors in the world today, given where the valuations of the market is, given the risk, that they would like to have some safe money, especially bond money that they've lost 10, 15, 20% on, that they could look at and they could say, okay, for 5 years, I know that I can't lose a penny, that I know that I'm going to get at least currently, the first 11.5% of the S&P 500. If I get a gain in that year, that gain is locked in, never to go back down. So if the markets go down, I don't give back any of those gains. And then when the market grows again, I don't have to use those gains to recoup losses, and I can stack gains on top of gains. That is a phenomenal strategy. That is something for some money, for some investors, that I think would appeal to them, especially if they're 5 years out from retirement, 10 years out from retirement. In retirement, that's a good allocation. Now, here's the difference. We're not telling you it's 100% of your money like most advisors do. We're telling you it may be 10%, it may be 50%, it may be 80%, it may be 30%. Who knows? But it is a good core component for some safe money. Why do we like that versus the lifetime income annuities? Here's the problem with these lifetime income annuities. Do you realize if they give you a bonus, 30% bonus, 40% bonus, 20% bonus, that's not real money? That is going to your quote unquote benefit base that they use to calculate income off of. Okay, fine, it's nice, but does it really matter? For people to think that they're going to grow their account, worst case at 7% a year. No, you are not. That is not real money. That is to your income base. So here's what the insurance companies are doing. The insurance companies know that you are only taking your own money out of that annuity until that account goes to zero. When the account goes to zero, then the insurance companies start to pay with their money. Think about that. You're only taking your own money out of that investment, that annuity, that quote unquote lifetime guaranteed income annuity until the account goes to zero. Well, the insurance companies know the account is 99% of the time, in my opinion, the account's not going to zero. They give you just enough growth to not let that happen. And they put a governor on how much you can withdraw. So you are really limiting yourself as far as what that strategy can do. So here's the deal. If you own one, let's get you out of it. of it. Let's talk about how we can get you out of it. If you're thinking about buying one, let's really uncover, do I want a lifetime income annuity that I don't think I'll have a benefit of, or do I want something that is a little bit short term that has more of a growth bias? So you can't say we don't like annuities. We don't like lifetime income annuities, and we're just going to talk a lot about this. I see the sales numbers of how many people are buying them, and the advisors are failing clients. So if you have one, let's talk. 630-492-1912, 630-492-1912. Give us a call. Let's have a conversation this week. More after the break.
Puzzled by your retirement options? It can be hard to put together a retirement strategy without being able to see the whole picture. Kuhn Capital Partners takes pride in providing comprehensive retirement strategy services to our clients. Our comprehensive services integrate all aspects of our clients' financial picture in a coordinated effort to provide for financial clarity and multi-generational wealth. Visit kuhncp.com or give us a call at 630-492-1912 to schedule a consultation today.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm and fiduciary. Yes, we are a fiduciary. It's important. I think that word is thrown around too much. But we are a fiduciary. We're independent. We have a custodial relationship with Charles Schwab. What that means is any clients who work with us have accounts at Charles Schwab. We are simply the money managers on it. That is critical today. Working with somebody that's independent, it just opens up a plethora of investment options that you do not have if you're with a big bank or a big brokerage firm. Again, do you want to be one of 1,000, one of 2,000 clients, or do you want to be one of 100 clients or one of 150 clients? Do you want to have products that are very limited, that the big banks, the big brokerage firms require those products to pay a sponsorship revenue share to get on their shelf? Or do you want to work with an independent that can do any investment vehicle out there? I would choose independent. If you choose independent, then let's have a conversation. Give us a call, set up a time for us to have a conversation, get on our mailing list for our dinners. The next dinner that's coming up is in Naperville at Morton's. Minimum investments that are required to attend the dinner. Again, they're not my minimum. They're the SEC's minimum. To qualify for this investment, you need to make $300,000 or more, or have a net worth not including your primary residence of over $1 million. So if you do meet those criteria and you want to learn how to reduce your taxable income by $90,000 active or passive per $100,000 invested, let's get you on the schedule for the dinner. Or if you can't make the dinner, let's have a conversation. We are not tax advisors. I want to make that clearly. Anything we talk about on the tax side is for educational purposes only. It's always best practice to meet or talk with a tax advisor before you invest in something for the tax benefits. That being said, these tax benefits are very, very black and white. So beginning of June is those dinners. So if you like to get on that calendar or learn or invite list and learn more about what we're doing, give us a call, 630-492-1912, 630-492-1912. So again, we want to talk a lot about making money, right? And I often think about, why I got into this business. And somebody asked me that question. And initially I got in the business to personally make a tremendous amount of money. I mean, that is exactly why I got into the business. I thought it was a great way to make a lot of money. That is what I thought about. I thought about how can I make the most money? What career path do I want to go down? And I remember my first day on the job, and we're going back to 97, beginning of spring of 97. And I just wanted to make a bunch of money. And so I thought, well, my goodness, advisors make a lot of money. So why don't I get into this business? And I look back and I think back about kind of the evolution of my career. And once you make your first chunk of money, everybody knows that chunk's different to everybody, right? To me, what I made and considered to be a lot of money, maybe you think that's pennies, right? But I made a bunch of money, and it was the first time that I really made any money in my career. And I realized quickly that if I'm just searching to make happiness in a career, and if you're only looking for money, then it's just going to be a very boring career. You're going to burn out. You're not going to like it. And a lot of that was true in kind of the first 10 years of providing financial advice in the form and fashion that I do. Spent a lot of time at a lot of different companies, spent time on the institutional side, working with advisors, and then back with individuals. And we're at the point right now where we started Kuhn Capital Partners in 2016 after, again, working with a large, nationally known brokerage firm, that we wanted to build something that was different. And I know everybody says that. It sounds really good, but we truly did. And we are trying to trailblaze and be trailblazers in this industry, in this financial advice business, in this financial advice game, because so much is wrong. So much is wrong with individuals that are giving advice. Many, many times, if not almost just 9 out of 10 times, the advice that you're given from the person that you're sitting in front of is not how they are investing their personal assets. That is not how they're investing their personal and family money. And it's probably not how they're investing their largest client's money. They are investing that money based upon something that is easily sellable to you, which is buy and hold, time in the market. Yet I promise you, in most instances, they're not doing that with their own money. They're doing it that way. The firms preach that because they spend tremendous amounts of money marketing that, because it's easy. It's easy to implement at scale. What do I mean by that? At scale, the advisor, if they're managing $100 million that way, guess what? It's easy to go to $200 million. It's easy to go to $500 million. It's, if they're making $1 million a year, well, it's easy to scale that to $2 to $3 to $5 million a year. And so that's great money. When we talk a lot about kind of the banknotes, what we're trying to, create is we're creating a new asset class of protected strategies. It takes a lot of time. It takes a lot of education. It is very, very labor intensive, because these structured notes, these bank strategies, these bank notes, call them what you want, they get called away a lot. And what that means is once they're called away, the investors get their principal back and we have to buy a new one. So it is very labor intensive on our part in managing that book of business. But here's the deal. It's a very, very good strategy for individuals. So throughout the summer, we're going to just spend a tremendous amount of time talking more and more and more about, especially with the market valuation. Market valuations are extended. Market valuations are very high. Yes, we could see a 20% correction. Yes, we could see a 40% correction. We're going into an election year. Inflation is still high. Growth is slowing. There's just a lot of things against the market. But again, that being said, it doesn't matter. So we talked about gut feel in the beginning. Yeah, my gut feel thinks that we need a correction, but my gut feel is no better than your gut feel. And here's the deal. Markets don't care about what you think or what I think. Again, that is why we have to use asset management strategies that are mathematical in nature, that are based upon what is going on, the inner workings of the market. When you look at AI can just, they can, the data that AI and the algorithms can comprehend and capture is just in a way that we can't do it. And I see just too many people not taking advantage of that. I see too many people not making the money that they should with their investments because they're still doing it the old way. They're still doing it the old way. They're still working with advisors that, think that they can outsmart the markets, that they can outsmart the computers, that are still using mutual funds or still using index funds. I mean, goodness, that you don't use a cell phone from the early 2000s. Why are you still using those strategies? People will say, well, you can't outperform the market. Yeah, 1,000% you can outperform the market. My goodness, we've got strategies in our growth bucket that have outperformed the market greatly. Our growth plus bucket that have absolutely destroyed the market. Now, again, past performance isn't indicative of future results, but you can. The people who don't want to outperform the market are working with advisors that just want to give market-like returns, whether the market's up or whether the market's down. Why are you working with those advisors? I just don't get it. Because isn't the job of an advisor to bring you strategies that can make money or preserve principal when the market is down? I mean, hello, that's the job of an advisor. If the market's down 10 and you're down 10, what value did that advisor bring to you? Why are you still working with them? And then the flip side is when the markets are up, I mean, isn't your job to capture as much money on the upside as you can? Now, we don't want people working with us because of performance, but at the end of the day, we are in a performance-driven industry, and our job is to make money. I've seen far too many people I've talked with from the radio show, from the dinners that we're doing throughout the Chicagoland area, that are nowhere near what the market is doing this year. I mean, or even last year. I mean, people are underperforming the market by 10, 15, 20%. And it's just mind-boggling to me that they are still sticking with the advice that they're the advice provider that they're working with. So working with an advisor is not a lifelong contract. And we're going to get, very, very much more proactive about strategies and proactive about, the fact that, yes, you can make money when the markets are down. Again, you can make money when the markets are down. And if you have strategies in place that can do that, I think what it just allows you to do is some of your more growthy type strategies, you're not worried about the volatility because you've got a big chunk of money that can deliver positive returns when the markets are down. And we had a conversation with a client, this week. We one single investment in the commodity space hasn't done very well. And it's like, my goodness, can't you see the future? Nobody can see the future. Nobody can see the future. But here's the deal. That strategy, when we had that conversation with the client, it's up now almost 80% since we had that call. I mean, in less than 6 weeks. And so there is no perfect investment strategy. It just doesn't exist. There's always a pro and always a con. And our philosophy, and I hope you hear me, our philosophy is to make sure that we have protected growth, we have growth plus, and then we have tax and alternatives. So our tax and alternative strategies, as you've listened to, and as we talk so much on the radio, is if you're worried about the markets, then why do you have all of your money tied to the market, where the success or failure of your investment portfolio at the end of the year is what the stock and bond market does? I mean, if you're worried about the markets, if you're worried about the valuation, then why do you have all your money tied to only those two asset classes? I mean, again, this is 2024. When you look at alternatives are plentiful. Alternatives are all over the place. Problem is, everybody talks about real estate. Everybody talks about multifamily. And those tax benefits, they're not that great. I mean, sure, it's passive income, which is better than being taxed at ordinary income, but there's no real tax benefits unless you own the asset outright and you're not part of a fund. Why aren't you looking at something then in the energy space? Our energy fund, the KCP Energy Fund. Again, last year, the tax benefits were significant. You invested $100,000. You were able to reduce your taxable income by $90,000, active or passive. And we have targeted distributions of 15 to 20% a year. We're literally investing directly alongside the industry leaders, Exxon, Chevron, ConocoPhillips, BP, Occidental, Devon, Mewbourne, you name it, at the asset level. I mean, in the single best oil and gas field in the United States, the Permian Basin. Google it, Permian Basin. See how much comes out. See where all the CapEx for all the majors are going. So here's the deal. If you're worried about the market, if you're worried about what's going on, if you think there could be a correction in the market, then why do you have all of your money tied to that? Don't play that game of in and out, trying to guess when the market's going to go down versus when the market's going to go back up. Leave that to the computers. If you wanted that type of a money management strategy, we've got a great one for you. Computer driven. It's not me making the money. I just give you access or the decisions. I just give you access to it for a more manageable level of an initial investment. And yes, that has beaten the market, the S&P, significantly since 2015. I mean, doubled it. But why do you have all your money tied to that strategy? How about you look at an alternative? How about you look at something that can pay targeted distributions of 15 to 20% that it really has no bearing upon what is going on in the stock and bond market. Oh, and by the way, you get to greatly reduce your taxable income. So if you own energy stocks, you're getting 2 to 3% dividend, no tax benefits. You need to consider shifting it to this. Tax benefits, significantly higher distribution, investing with the best operators at the asset level in the best oil and gas field. most people are not hearing anything close to that strategy. So 630-492-1912 if you want to learn more about it. 630-492-1912. More after the break.
When you think of a puzzle, what would you say is the most important piece? A corner? A side piece? I would argue the most important piece of a puzzle is the picture on the box, and the same can be said for your retirement. Robert Kuhn from Kuhn Capital Partners would love to show you your retirement picture. For more information, call 630-492-1912 or visit his website at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm and fiduciary. Our job, again, as you know, is to include strategies that can deliver positive returns in negative markets, strategies that can preserve principal in negative markets, and strategies that can outperform in positive markets. That is the job of an advisor, in my opinion. Our job is definitely financial planning based. Our firm is financial planning based. We are financial planners, but we also like to make money, whether the markets are going up, down, or sideways. We're going to include strategies that most advisors simply are not. So if you want to have a conversation with us, 630-492-1912, 630-492-1912. We would love to talk with you during the week. Would you be shocked to learn that every month in 2024, the GDP was, or new home sales was actually revised down? Think about that. Every month in 2024, it was revised lower. A lot of people are in real estate, and we love real estate. We love real estate. So we're not saying anything bad about that. But I think if you pretend the economy is doing great one month, then nobody cares later after it is revised down. So, one of the reasons I like that, kind of I look at what's going on in the real estate space, in new home sales, prior versus reserved is or revised, which I just think it gives you an idea of kind of what's going on in the world today with individuals. And we have some good friends that are great realtors, phenomenal realtors, some of the best realtors that I think are out there. But there's a lot of concern in the general economy. And I think there is some concern with interest rates not going down. That is a concern of mine. That is a concern of, I think, most people's, that we came into the year expecting 6 interest rate cuts. Inflation is just not cooperating. So what does that do to the market? Again, nobody knows. And my crystal ball is not any better than your crystal ball. If we're going to use crystal balls, let's let the computers decide where and what to invest in. That is what I like. That is our philosophy, whether it's our growth strategy or our aggressive growth strategy, which we call Growth Plus. We let the computers tell us what to do. We believe in quantitative analysis. We believe that the computers can just take information and process it in a way that nobody else can, certainly not at the speed. And so, our job, I think, again, is to educate. And most individuals just don't understand that there are momentum-based managers that you can have access to. They have the computing power. They have the data scientists. They have the PhDs. They have the mathematicians on staff. The days of trying to outsmart the market, trying to find something on a balance sheet that nobody else does, good luck. I just think you're fighting against AI. I think you're fighting against the computers, and I think it's just an issue. And I think that's one of the reasons so many people have underperformed this year and last year. So, when we look at growth, we don't talk a lot about our growth strategies on the radio. There's one show that talks about computers and talks about models, but yet they show you performance that didn't exist. They show you backdated performance that wasn't around, which, take that for what it's worth. Who's going to show you bad historical performance if it's computer generated? Nobody would invest in it, right? So that is a whole nother topic in and of itself. But, we don't talk about strategies that can outperform the market. We don't talk a lot about aggressive strategies. And I think people don't talk about aggressive strategies because they say their risk tolerance can't handle it. Well, that's not true. Because if you're structured correctly in a portfolio, there is no reason that 10 to 15 to 20% of your money should not be aggressive, should not use computers, should not try to outperform, should not, be able to really get after it. The reason you don't do it is because your safe money is probably down because you've been in bonds, right? And you're just doing more of, the same basic types of strategies. And that to me is why individuals aren't comfortable with having some money that can really get after it, some money that can utilize the computers and really try to outperform. What if 50% of your money that you knew you couldn't lose on? Couldn't lose. 50% of your money you could not lose on. You knew it was principal protected. How much of the rest of the money would you be comfortable with having a little bit of an aggressive strategy? I mean, that can really get after it. That can, if you look at what has happened since 2015, is doubled what the S&P did. Doubled. I mean, that is significant. Again, past performance is not indicative of future results, so I want to make sure you understand that. But I don't think that you can't handle the volatility. I just think that your advisor doesn't have you correctly allocated to know that the bulk of your money, even if the market is down, is protected. This whole adage of you can't outperform the market and you have to be in index funds. I mean, why are you working with an advisor to put you in index funds? You can do that on your own, or you can find somebody like me, pay me $1,000 a year. We'll give you a good asset allocated strategy, and then you invest it yourself. I just don't get it. And, we're going to really talk a lot about it. So Jamie Dimon, many people know who Jamie Dimon is, CEO of JP Morgan Chase, arguably the best bank in the world, the most financially secure bank in the world, possibly the best banker in the world, Jamie Dimon. We have a lot of respect for Jamie Dimon and what he has done. We have a lot of respect that he just kind of tells you what it is, how he feels, even if it's not popular. That is something that I think is very, very critical. He has been hinting that he is preparing to retire sooner than the 5-year plan that he has laid out. I have no idea. I don't know Jamie Dimon. That could be totally false, but at least that's what's being reported. Many people are wondering, is he jumping ship before the market's really correct, before that there are issues? And that may be. I don't know. That may be. That's one of the reasons I love the finance business, and I love advice business. It's so easy for an advisory firm to scale to significant levels if they talk about basic stuff. Basic stuff doesn't mean it's good for you. Basic stuff means it's great for the advisor. It's great for their pocketbook. They can make, $1 million, $2, $3, $4, $5 million a year without adding any value other than what the market's doing. And guess what? If that's how you want to invest, go to Fidelity, go to Schwab, go to Vanguard, do it on your own. I mean, just do it on your own. Don't pay our fees. I don't think that's the best way you accumulate wealth. I don't think that's how you compound your money, because generally speaking, you're going to go up and down with the market. And when we see statistics like the S&P 500 is near an all-time high, while the S&P 500's earnings yield has collapsed and is at 2008 levels and still moving forward or lower, you have to ask, why are people bullish? I mean, there is a lot of issues that we are facing today. But again, we're talking about what is driving the market up. And I think, again, it's computers. I think computers are driving the market up. I think computer trading is what is continuously going to push this market higher. And you have a couple, options. Fight it, say it's bad, wait, let your money sit in cash and tell me how you have to see a correction, then you'll get in. Well, I can't tell you how many people I've, seen who have underperformed the market greatly last year and this year. Or you could take advantage of a strategy that utilizes the computers, that utilizes mathematical algorithmic models, that utilizes and doesn't care, utilizes, math and science, but it doesn't care what my gut feel says. It doesn't care what your gut feel says. It just lets the markets do what the markets are going to do. I mean, there's a tale of two markets. You got the names that are moving, and they got everything else. And the names that are moving, yes, it's broadening, but still it is very kind of concentrated. Those are moving. Generally, they're in the high-tech space, but most advisors are going to tell you that you can't have an overweight in high tech because it's aggressive. Well, okay, fine. Maybe so if you have, fixed income and you just have a traditional portfolio. But what if you have a portfolio that you have a good chunk of money that your worst year is zero? Well, maybe, just maybe, you can overweight the names that are moving. Today it's tech. Tomorrow it might be pharmaceuticals. The next day it might be energy. The computers can tell you what it is. That's why you have to, in my opinion, work with a money manager that utilizes and has access to those types of strategies, has access to strategies that you simply can't gain access to, and that we can look at and let the computers do the money management for us. Now, again, it's not perfect. There is no perfect strategy, but if you have a big chunk of money that can't go down and you know your worst year is zero, or you can even make money when the markets are down, what does that do to the other side of your portfolio? Get after it. Don't use index funds. My goodness. What are you thinking to pay an advisor to use index funds? I just don't understand. Great business model. My goodness. You can just, sit and tell the client that, well, you're going to just do what the markets do, up or down, and you're going to pay me for that. You have to use a cutting edge proactive advisor that is using the latest and greatest strategies that Wall Street is utilizing for their own money, that advisors are using for their own money, that money managers are using for their own money. That's what I think you need to do. 630-492-1912, 630-492-1912. So I saw a fascinating statistic. And again, it goes back to annuities. There was a great article out there. Do rich people buy annuities? Yeah, they do. Unfortunately, they buy the wrong ones. They buy ones that have a lifetime income guarantee that unless the account goes to zero, you're paying for a benefit that you will never use. Annuities, I think, if you look at what annuities are, again, if we look at the growth annuities, if we look at short-term annuities, I think an annuity really is a structured note. I think annuity is really just, at least the ones that we use are very short-term dated, and they're simply tied to the S&P 500. That way we can mathematically quantify what's good, what's not good, because I've seen far too many people buy these lifetime income annuities that have no growth, very, very limited growth, because they're all volatility controlled. And if you look at what happened in the bond market, it's negated almost all of the equity side growth. So if you were sold an annuity based upon somebody laying an illustration in front of you that showed 15% returns, 18% returns, 20% returns, and you've had nothing near that growth, unfortunately, those illustrations are very, very, very misleading. So we're here to help you. We're here to uncover, demystify what you should be buying if you want protection. We can help you do that. Don't buy a lifetime income annuity that has a governor on how much you can take out. What about inflation? My goodness. You take out 5 to 6% today. What's that going to look like in 10 years, 15 years? Your purchasing power could be cut in half. 75% less purchasing power. If you want the annuity, if you want the protection, let's look at a growth annuity. Let's look at something that's in the 5-year space that is tied simply to the S&P. Those warrant a significant. We just want to look at them. We just want to look at them if that's what you want. So yes, rich people do buy annuities. People with wealth, they like to manage risk. People with wealth do know that if I could put $1 million in something that I know my worst year is zero, and I know currently I get the first 11.5% of the upside of the S&P. Again, this is safe money. That's something that a lot of people will jump on. That is something that people with significant sums of money will allocate capital to, because it's all about compounding, right? Isn't it all about compounding your money? What's the greatest destroyer of compounded returns? Losses. Well, if we can negate those losses for some of your money, then we're not having to use future gains to try to recoup those losses. So yeah, we can absolutely, rich people absolutely do buy annuities. They just unfortunately buy the wrong ones. So 630-492-1912, 630-492-1912 if you want to have a conversation. If you want to debate lifetime income annuities, let's do it. I love it. We can still be friends afterwards, but I'd love to hear why it's a benefit to you. 630-492-1912.
Perhaps the most impactful piece of preparing for retirement is determining your current and future tax liability and developing strategies to minimize the amount of taxes you pay in retirement. Tax planning can have a large impact on your wealth and the kind of legacy you will be able to leave. At Kuhn Capital Partners, we provide you with a retirement strategy that can help you minimize taxes in retirement and take advantage of the 2024 tax rules. Visit KuhnCP.com or call our office at 630-492-1912 to get started today.
Okay, welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent registered investment advisory firm. Yes, we are a fiduciary. That is very, very important. I think our job is to make sure that first and foremost, we have an actionable financial plan, a financial plan that is a living, breathing document, not one you just see when you start to work with an advisor, but something that we can actually benchmark in our quarterly. We actually do 2 reviews a year, spring and fall, and we can benchmark that. We like a plan that you can log into, that is updated, and that you can see. So yes, we do believe in a roadmap. We do believe in financial planning. However, that's not really a differentiator, at least in my opinion, on why you work with somebody. I think you work with an advisor because that they can weather the down markets, because they can bring strategies that can do well when the markets are down, because we can have principal protected strategies in a portfolio, because we can have strategies that are computer based, that are mathematically based as far as buy sell decisions that have been around for decades. You just generally can't gain access to those strategies, but those are strategies that advisors, those are strategies that Wall Street are using for their own money, but they're telling you that, nope, can't do it, buy and hold, don't worry about it, it's not time in the market, or timing the market, it's time in the market, blah, blah, blah. Those are dated strategies. We want to work with people who want proactive strategies. We want to work with people who want to greatly reduce their taxable income. We want people who want to have a chunk of money that can have targeted distributions of 15 to 20% annually, regardless of what is going on in the stock and bond market. Those are the individuals that we want to work with. So 630-492-1912, 630-492-1912. Again, past performance is not indicative of future results. There is no perfect investment strategy. We're not trying to say that there is, but we do things different. We are changing the investment advice business. And if you want to get with that change, if you want to utilize strategies that advisors are using for their personal money, for their immediate family's money, but yet they are advising others that they're giving financial advice to do something totally different, that's not good for, that's not something that we're not going to be a good fit for you. But if you want strategies that we are utilizing for our own personal money, for our own immediate family's money, and you want to use the most cutting edge strategies to make the most amount of money as you can while limiting portfolio losses, including strategies that can do well, can generate positive returns even when the markets are negative, then we're going to be a good fit. 630-492-1912. Now, here's the deal, though. That all sounds really good, right? It all does. Beat the market when the market's up, make money when the market's down. Those are really great talking points. Those will get people to reach out all day long. Here's the challenge, though. A lot of our strategies are going to take you some education, you the opportunity to learn something new. They're not new strategies. They're just going to be new to you. And so if you don't have the willingness to learn something new, to learn the true pros and cons of an investment, to learn what institutional type strategies are, because they're different than what the retail investment advisors are bringing to the table, then just save your time, because we believe first and foremost that we're educators. We're educators at heart. We're going to talk to you about what a dual directional banknote is. We're going to talk to you about how, yes, you can have a cap on the upside of close to 20%. Yes, you can make money if the markets aren't down more than 20%. You can generate positive returns in that strategy. Markets down 10, yes, you can make 10%. But you're going to have to learn something new. You're going to have to, again, strategies aren't new. I mean, Calamos Investments came out with a really innovative strategy, I think, that's very cutting edge in my opinion, and is very forward thinking. They had a statistic that I read when I was reading the fine print, which most people don't do. I was reading the fine print of their strategy, that in calendar year 2023, I think it was $400 billion was invested in annuities or strategies that provided protection of some sort. So the numbers are clear. People want to have protection. Again, you hedge every area of your life: health insurance, car insurance, homeowners insurance, life insurance. I mean, come on, why do you do that? Well, it's to protect against loss, right? But yet when it comes to investments, you have no hedge in place. Not your fault. again, it's not your fault. Unless you're managing your own money, then you are the one that you have to answer to. So if you're managing your own money and you have no hedge in place other than fixed income, well, then I guess the buck stops with you. But it's the advisor's fault. It's the advisor's fault, and shame on them for not including strategies inside of a portfolio for investors. Even if you have $100,000 to your name, we have strategies for you. If you have $10 million, $20 million of investable assets, we have strategies for you. It's just most people, most retail investment advisors are not going to bring strategies that have a hedge component, strategies that can make money when the markets are down, because they don't want to educate, because they don't want to upset the apple cart. They're already making seven figures, so they don't care. They just don't care. They want to just do more of the same. And guess what? It's worked out because the markets have done nothing but go vertical, other than a couple of years. But I don't care what the market's done looking at yesterday's market performance. I want to know, where do you think the markets are going to go in the next 3 to 5 to 7 to 10 years? And if I ask people that, they're very concerned. They think slow growth, high inflation, slow growth, high inflation. That's why these lifetime income annuities scare me to death. That people are buying these lifetime income annuities that, unless the markets go to zero, there's no benefit for them. And the insurance companies are only going to let you take out 5 to 6% of your investments. How is that going to be affected by inflation? I mean, think about that. 6% today. What's that 6% today going to be in 10 years? 3%? 2% purchasing power? So again, we're going on the offensive. Again, you can't say that we don't like annuities, because we have the best, and we love a 5-year annuity that's tied to the S&P. Again, if you just joined us, there are strategies that are principal protected against loss. There are strategies that your worst year is zero. There are strategies that if you get a gain up to 11.5% of the S&P, which is very acceptable for many people, that gain is locked in, never to go back down. So if the markets do go down, you don't give up a penny of those gains. And then when the markets go back up, you don't need to use a penny of those gains to recoup losses. That's a strategy that we like. 630-492-1912 if you want to learn more about it. That fits into our protected growth bucket. We've got 3 other buckets. We got a growth bucket, we have an aggressive growth bucket, and we have a tax and alternative bucket. So I see the numbers, folks, and I listen to the radio shows just like you do. We're going to be front and center, leading the charge on these guaranteed lifetime income annuities. And again, under $250,000 of investable assets, that's all you have to your name. You know what? Maybe it's the best thing going, but I've seen the illustrations. I can use the illustrations that I could look at. If I put in $100,000 and I'm going to use a lifetime income annuity, I can see the benefit base being $300,000 to $400,000 in the next 5 to 10 to 15 years, and you're going to get income on that number. Well, guess what? Here's the problem. Those indexes didn't exist up until 2 or 3 years ago. So they're just using fictitious hypothetical data. And I'm here to tell you that most of the time it doesn't work out. So if you own a lifetime income annuity, you want to know if you can get out, let's talk about it. If somebody is selling you a lifetime income annuity and they're telling you it's the best answer and it's the only answer, really just ask yourself a simple question. What benefit do I have if my account doesn't go to zero? Ask the advisor. The answer is none. What happens if inflation continues to rise and go up, which everybody thinks that it's going to, and they're putting a governor on how much of my own money I can take out? Is that an issue? Well, the answer is yes, but they'll probably tell you no. So that being said, we're looking forward to a great summer. We are really just going to take this radio show up on strategies, talk about good, the bad, the ugly, talk about what advisors are doing, why I think 99% of advisors add absolutely zero value to the client relationship, why I think that we do add value, and I know why we add value. Number one, financial planning. Is it a differentiator? No, but it is a good financial plan that I think is the best in the industry. We want to add value by allowing you to make money when the markets are down, and we want to add value by allowing you to have strategies that can outperform the markets when they're up. So with that said, if you want to talk about the tax strategy that we talked a lot about this week, reduce your taxable income last year, $90,000 per $100,000 invested with targeted distributions in the 15 to 20% space. Let's have that conversation. 630-492-1912, 630-492-1912. Everybody have a great week. We'll be back next next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.